You wake up one morning and nothing feels different. Your phone still works. Your job is still there. Coffee costs about the same. But somewhere in a quiet building, a group of people you will never meet adjusted a number by 0.25%. And because of that, your rent will rise, your debt will last longer, your savings will quietly lose power. Not today, not tomorrow, but soon. That number is called an interest rate, and it controls far more of your life than you've ever been told. This isn't a conspiracy, it's not a secret meeting in a dark room, it's much more ordinary than that, which is exactly why it works. Right now, interest rates matter more than they have in decades. Not because economists say so, but because the cost of simply existing is being quietly recalculated. Let's talk about how that happens, step by step. Without jargon, without lectures, just the system, and the math hiding underneath it. Because once you see it, you can't unsee it. Here's the uncomfortable truth most people never hear. Interest rates are not about encouraging saving. They are not about punishing spending. They are not even primarily about inflation. Interest rates are about control, not political control, behavioral control. They are the steering wheel of the economy, and you are sitting in the back seat. Let's rewind. Imagine money as water, not metaphorically, functionally. When water is cheap and abundant, people use more of it. They water lawns, fill pools, waste a little. When water becomes expensive, behavior changes. Suddenly people conserve. They delay usage. They rethink needs versus wants. Interest rates do the same thing, but instead of water, they control time. Specifically, how expensive it is to borrow time from the future. An interest rate is simply the price of using money you don't have yet. That's it. No mystery. But that price quietly dictates nearly every major decision in your adult life. When you buy a house, when you buy a car, when you start a business, when companies hire, when governments spend, even when you feel secure or anxious about money. Let's zoom in. You don't buy a house? You buy a monthly payment. You don't buy a car. You buy a monthly payment. You don't choose a lifestyle. You choose a payment schedule stretched across years. And interest rates determine how heavy that schedule feels. A 1% change sounds small. It isn't. On a 30-year mortgage, a 1% increase can mean paying tens or even hundreds of thousands more over time. Same house, same job, same life, different number. So who sets this number? Not the banks directly, not the government exactly. It's usually a central bank, an institution designed to be boring on purpose. They don't shout, they don't campaign. They release statements filled with words like measured, gradual, and data-dependent. But their decisions ripple outward faster than headlines. Here's how the chain reaction works. The central bank adjusts a short-term rate. This rate affects how much banks charge each other to borrow overnight. Sounds irrelevant. It isn't. Banks don't operate on their own money. They operate on borrowed money. So when their cost goes up, they pass it on. Slowly, quietly, everywhere. Credit cards, mortgages, auto loans, business loans, all more expensive. At the same time, savings accounts and bonds may pay more. This sounds fair, balanced. But here's the catch. Debt reacts faster than savings. Your credit card interest rate can jump within months. Your wages do not. Your rent adjusts yearly. Your paycheck doesn't automatically follow. So higher interest rates hit borrowers first. And most people are borrowers, whether they like it or not. Now let's talk about inflation, because this is where the official story usually ends. The standard explanation goes like this. Prices rise too fast. People spend too much. So we raise interest rates to slow spending. Simple. Clean. Almost comforting. But reality is messier. Inflation isn't just about people buying too many things. It's about supply chains. Energy, housing shortages, corporate pricing power, government deficits. Raising interest rates doesn't fix most of those. What it does do is reduce demand by making life more expensive. Not strategically, broadly. It doesn't target luxury spending. It hits essentials too. Rent, transportation, utilities, food production costs. Which means inflation can sometimes fall not because things became affordable, but because people ran out of room to spend. That's an important distinction. Now here's where interest rates really start shaping your life without permission. They influence risk. When rates are low, borrowing is easy. Money flows into startups, real estate, speculation. Mistakes are forgiven. Failure is survivable. When rates rise, the system tightens. Suddenly, only the safest bets get funded. Small businesses struggle to get loans, hiring slows, layoffs begin. Nothing collapses instantly. It's more subtle. Job listings quietly disappear. Raises get delayed. Contract work replaces full-time roles. People feel it before they understand it. And then comes the irony. By the time most people realize rates are high, they're already paying for it. This is why interest rates feel invisible but personal. You never get a notification saying your future just got smaller. You feel it as stress, as hesitation, as delay. You postpone buying a home. You delay having kids. You stick with a job you hate because switching feels risky. That's not accidental. Higher interest rates reduce movement. They slow everything down, and from a system perspective, that's the goal. Stability through friction. Now let's talk about the uncomfortable math nobody likes to explain. Compound interest works in both directions. When you are investing, it's your friend. When you are in debt, it's relentless. At higher rates, interest compounds faster than effort. You can work harder and still fall behind. This isn't a moral failure. It's arithmetic. And here's the quiet absurdity. The same system that tells you to be financially responsible is structured so that responsibility becomes harder when rates rise, saving becomes more important, but living costs more. Debt becomes more dangerous, but avoiding it becomes unrealistic. So people juggle, refinance, transfer balances, stretch timelines. Not because they're careless, but because the system demands constant adaptation. Now zoom out. Interest rates don't just control individuals. They control governments. Higher rates mean higher debt servicing costs. That means more tax revenue goes to interest payments instead of services. Less infrastructure, less social spending, more pressure to cut, which feeds back into the economy. Lower growth, more inequality, more reliance on credit. This is the loop. And once rates rise high enough, something usually breaks. Not dramatically at first. A bank fails, a market freezes, a temporary liquidity issue appears. Then suddenly the same institutions that raised rates start cutting them. Urgently. Because the system isn't designed for comfort. It's designed for survival. This cycle repeats every generation. Different names, same mechanics. And most people experience it only as background noise until it hits them personally. A rejected loan, a rent hike, a job loss timed perfectly wrong. So, what's the takeaway? Not that interest rates are evil, not that central banks are villains, but that this single number quietly scripts the boundaries of your choices. It determines how expensive your future is allowed to be. And the unsettling part isn't that it exists. It's that almost no one teaches you how deeply it governs your decisions. Until you're already inside the system. So here's the question worth sitting with. If a small change in a distant number can reshape your career, your home, your stress, and your freedom, how much of your life do you actually control? And how much of it is simply reacting to interest?